Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our special edition of the IFRS 17 Technical Update webcast. The series has restarted after we had a few months where technical updates were no longer the main topic of our webcast service. But today we cover the IFRS 17 Transition Results Group meeting that was attended last week. This is the group that was established in the early autumn last year, when 15 individuals, including myself, have been selected to debate the issues that will arise from the implementation of IFRS 17 and to help the IASB and everyone else around the world to do the best possible job in getting compliant with IFRS 17. That has to be done, as we all know, for a calendar period beginning on or after the 1st of January 2021. The structure of the webcast begins with an introduction where I will remind you of the purpose of the TRG, and then I will use a two-step phase approach for each of the papers that were debated last week. First I'll give a background on the papers, and then I'll give you a summary of the key output of the TRG discussions. At the end I will have a few minutes for discussion on the next steps following last week's meeting. To introduce the TRG, I thought it would be useful to remind you of the purpose of the TRG for IFRS 17. This is to invite discussion and analysis of potential stakeholders' issues arising from implementation of IFRS 17. We have a membership of 15 individuals. 6 are extracted from the large networks of professional services organizations like Deloitte, and 9 are coming from a geographically dispersed preparers group, so CFOs and chief actuaries and implementation leaders of different insurance companies from Asia, European markets and the Americas. This group of people will be gathered on a regular basis quarterly to provide a public forum where we will be discussing and learn about the new requirements from IFRS 17, and also help the IASB determine whether additional action is needed to support the implementation of the new standard. For example, whether they should provide clarification or issuing other guidance, up to and not excluding the possibility for the IASB to decide on an amendment to IFRS 17. All the other guidance that would normally be produced is expected to be non-mandatory in nature, and so it will be effectively explanatory, illustrative, educational. But if the IASB were to decide to make an amendment, and that amendment would have been approved and implemented, then the text of IFRS 17, the required text, will change. This was the first meeting. Currently the IASB has planned for 4 meetings on a quarterly basis, beginning in February. The first meeting was the 6th of February. The next one will be on the 2nd of May, and so on. There is also a possibility for a 5th and final meeting in the first half of 2019. At this meeting, a number of papers were debated with dedicated agenda papers, 6 of them to be precise, and then there was an umbrella paper that covered all the other submissions that had been received up to this point, for which the IASB staff and members, in their judgment, had decided not to develop dedicated papers. Yet, for each of these issues, there was a commentary that was either a rejection for the submitting party to inform that party and everybody else in the world about the reasons why the submission was not expanded in an agenda paper for the TRG, or whether there will be other channels that the IASB will then use to debate the relevant issue. For example, deferral to a next TRG meeting if the submission was valid but too late in the coming. There are 4 main topics that were covered by the 6 papers. The first one is different applications of the contract boundary requirements. The second is the treatment of acquisition costs for future expected renewals. The third one is accounting for multi-coverage insurance contracts, and finally there was discussion on how to define CSM coverage units. Let me begin with the issue around separation of insurance components of a single insurance contract. This was agenda paper number 1. The background to the paper is that IFRS 17 is an accounting standard that has been designed to regulate the accounting for insurance contracts. And one of the first things that IFRS 17 requires the issuers of insurance contracts to do is to analyze those contracts for identification of components that may be distinct from the insurance contract. Those could be embedded derivatives, investment components, and obligations to deliver goods or render non-insurance services. IFRS 17, once the unbundling requirements are applied and identify any distinct non-insurance components, required to account for those distinct insurance components separately under another accounting standards, either IFRS 9 for derivatives and investment component, or IFRS 15 for the non-insurance services component. And what remains is the contract, stripped out of those distinct components, which remains entirely within IFRS 17 scope for measurement and recognition. IFRS 17 also sets out the requirements on combining a set or a series of insurance contracts with the same or related counterparty that may achieve or be designed to achieve an overall commercial effect. So in this case we have multiple separate, legally separate contracts which from an economic perspective, because of this overall commercial effect criterion, will get combined and accounted for as if they were one contract. The paper discusses the fact that a question may arise as to whether an entity is permitted or required to split multi-coverage insurance contracts and include them as a result in different groups of insurance contracts. The TRG submission also asks whether it is possible or required to split components of reinsurance contracts, both as issued reinsurance contracts or as held insurance contracts, and account for them as separate reinsurance contracts. So the key question is whether IFRS 17 permits or requires the separation of insurance components of a single contract for measurement purposes. The summary of the discussion should start from the fact that the staff highlighted that a contract would generally be considered as the lowest IFRS 17 unit of account after unbundling is completed. That was a premise that called for an extensive number of interventions from the IASB members and the IASB staff present at the meeting. And clearly I could see that there was a very strong distinctive intensity in making that point come across, because they probably appreciated, and when you read the paper you probably share the same level of appreciation, that the submitting party had questioned whether there was an actual optionality in the separation of the individual insurance coverage components. A number of TRG members agreed with the staff's view. However, they also note that there may be circumstances where one legal contract does not necessarily reflect the underlying economic substance. The IASB staff noted, upon hearing those observations, that effectively the combination of different multiple coverages, all of which individually will actually be in the scope of IFRS 17, but are effectively bundled together in a single legal insurance contract, per se is not sufficient to conclude that the substance of the contractual rights and obligations is not already reflected by accounting for the whole contract. The segregation of insurance components within a single legal contract is not an accounting policy choice. That was made clear by the opinions expressed by a number of board members present and staff present. I actually indicated my personal agreement with that conclusion. However, I believe that there was agreement from TRG comments that there is clearly an overarching principle that comes from the IFRS conceptual framework, which says substance must prevail over form for all IFRSs, not just IFRS 17. And this is a key piece of guidance on the interpretation of all IFRS requirements, not just the ones from IFRS 17, that needs to be carefully analyzed and critical judgments developed in terms of whether or not the substance of a contract must be taken in a different form than the one that would come from just the accounting of the contract as it is legally constructed. In discussing that particular situation, and in my personal opinion, it's a limited frequency, there were a number of examples that the staff of the IASB highlighted they would personally consider in assessing whether substance would override the form of a contract. None of this is necessarily written guidance. It is a view of the IASB staff expressed during the meeting last week. The presence of interdependency of cash flows or the absence of that could be a factor to consider in assessing whether the substance is reflected by the contract or not. Another factor would be whether the components of a multi-coverage contract would be able to lapse separately or not. Again, the absence of a separate lapsation option would indicate that the contract is probably already substantively aligned with the economics of the transaction and doesn't need to be broken down. Different components could be sold by entity separately as a standalone contract, as well as being components of a multi-coverage contract. These, for example, would be an indication of separation if that fact exists, or absence of the fact could actually indicate that the separation may not be required. Finally, different components could be managed separately in a pool of items that may share the similar risks, or multi-coverage contracts could be managed together as contracts. In that case, the indication of one contract could be the prevailing conclusion. These are all useful points of discussion that I felt were valuable for collection and reporting back to you. But let's remember, everyone, that this is not authoritative guidance. However, we at Deloitte, and I'm sure that all organizations will take this very seriously, we need to develop our own interpretation, and this is clearly an important source that we will consider in doing that. I just want to quote a couple of examples that were used during the debate. One comes from general insurance, where you have, we heard one TRG member explaining that in their SME segment, SME being small, medium enterprises or commercial lines, general insurance, they often offer umbrella contracts that package together different coverage that are typically purchased by SME clients, like public liability, employees liability. The TRG member in question observed, however, that from a management of the risk perspective, there is no interdependency. There could be also situations where one component can be lapsed independent of the other, and so on. So she noted that that could be an example where the substance will be better represented by looking at those coverages separately. In life insurance, often we see that different coverages, sometimes death risk, sometimes longevity risk, are part of the same contract, and they just intervene in the expected lifetime of the coverage at different points in time. Let's consider, for example, pension with an accumulation phase that carries a death benefit, and then a payout phase where death benefit is expired, but the longevity risk kicks in on the grounds that the policyholder receives a lifetime annuity. So all these examples clearly were taken into account, and I believe that the outcome was conducive of some positive practical clarifications that we all can take into account in accounting for complex contracts. The next paper I want to cover is Agenda Paper 2. This paper focused on the application of the contract boundary when there is an annual repricing mechanism. I'd like to start by recapping what the contract boundary requirements are, particularly the ones that come from paragraph 34. Deloitte, in our training, I got this decision tree that is a flowchart that we find particularly useful to explain how the contract boundary requirements in paragraph 34 operate. The first requirement is to make sure that you don't have a contractual enforceable right to demand the payment of premium as an insurance company from your policyholder, because if you do, then the boundary will certainly stretch for as long as that right to demand payment for premiums in the future will last. Absent that, the interesting part begins with paragraph 34A, where the requirement is to assess whether the insurance company has the practical ability to individually price the policyholder for the risk transferred from the contract. If that full repricing of the policyholder risk exists, that date when such ability exists, irrespectively of whether it is exercised or not, that date becomes the boundary of that contract. However, if such a right to individually repricing individual persons within the insurance contracts does not exist, there is a dual test under 34B. The first part of the test is to see whether the insurance company at the portfolio level has got the same practicability that I referred to earlier would exist at the individual policyholder level. So this one is different because it's done at the portfolio of insurance contracts level. So this means that if you do have that practicability and you do that on a particular date, that could become the contract boundary. So when is this date, the reassessment date or repricing date, a boundary for the contract? That's when we go to 34B Roman 2, and that paragraph tells us it is the date of the boundary if the reassessment that is carried out only takes into account the impact of the risks up to and only up to that date. If the reassessment of the risk instead considers risks that go even beyond that time horizon, that is from the date you do the reassessment to the next reassessment date, then the boundary is long. So 34B Roman 1 sets the scene, portfolio repricing, and then depending on how you do the portfolio repricing, you can have a short boundary or a long boundary, depending on the horizon of the risk assessment that you have taken into account in carrying out that pricing. And so the submission has presented two examples. Example A is a step-rated insurance contract where there are some guaranteed renewable covers, let's say medical insurance, medical expenses, that will not need any further underwriting of the individual policyholder. So the policyholder walks in to the insurance company, goes through a medical test, is given a price, and that is the only time he has to see a doctor for the insurance company. From that moment onwards, his or her health can improve, deteriorate, it doesn't matter. It will be continuously be charged by the insurance company based on a table. The key here is that the table will also tell him at that point in time that today, being the age of that policyholder, say 45 years old, he or she will pay $10 per month to receive that cover. And then the same table will tell him that when he gets to his next birthday and he becomes 46, the premium will go up to $11 and so on. So there will be a table that will effectively step rate upwards the payment that the policyholder will do as he becomes older. The pricing point is on an annual basis. The insurance company can look at the experience that has come from all these individual policyholders together in the portfolio, and without asking any of them to go back to the doctor because they don't have the right to ask for that, they will then calculate what would be the new table that they may want to put in place from the repricing date prospectively. So at that point, the repricing date may, a new repricing table may be in place, in which case the old table is withdrawn and a new table becomes effective. The customers that have been renewing will then apply the new table. The old one is gone, is no longer there, but again without having any guarantee being taken away as far as their medical condition could be at that point. Is still going to be paying based on the portfolio assessment, not the individual assessment. And new customers coming in will join in the portfolio at the price based on the new table. The second example is exactly the same contract, but this time seen as a rider on top of a regular premium unit-linked saving plan, which creates then a unit-linked insurance contracts with regular payment premium, where the unit-linked investment component is repriced on a fair value basis on a regular basis. And so effectively both have the same level of insurance to risk transfer, both have got the same characteristics on reassessment of these insurance risk. And the key question then is, would contract A and B have a long or a short boundary? There were mixed views. You will have read the paper now, paper 2A, paper number 2, and you will have seen that the view of the staff was that both contracts had a short 1 year only boundary. But a number of people had different views. For once, I personally have expressed the view that both contracts actually had a long boundary, because I could see that the repricing mechanism would indicate a time horizon which was beyond the next reassessment date. The staff confirmed that in their analysis in the paper, the cash flows from renewals, as they call them, beyond that reassessment date would not be part of the boundary, and they will have to be accounted for as new contracts. So if you look at the product B in the example, that would have meant to turn these regular premium contract into a series of 1 year single premium contracts with an accident and health rider. A number of other TRG members noted that these guaranteed insurability at the variable price for portfolios is still a very substantial benefit, given that the deterioration in health is never repriced at an individual basis, and it's only affecting the price of that particularly unfortunate policyholder whose health is deteriorating, only to the extent that it changes the price for everybody else in the portfolio. Also, the smooth progression of the rates in the table, I indicated that would be a sign, if like a symptom of a pricing technique that is actually looking beyond the 1 year horizon. The staff noted all these points and then provided us with an additional piece of feedback which clarified the nature of the risk referred to in paragraph 34b. They explained that if we read carefully 34a and b, 34a is articulating the definition of what risk the insurer is reassessing in a way that, in their opinion, is much clearer than it is in B of paragraph 34. And that risk is exclusively the risks that the policyholder can transfer by entering into the contract. So we're talking about pre-existing risks. And then in discussion, the IASB staff explained that they will rate insurance risk and financial risk as two examples of pre-existing risks, but they would definitely exclude policyholder behavior-related risks, for example, lapse risk or expense risk, because these are created by the contract. In other words, the insurance company would not be exposed to those risks if decided not to sell that particular insurance contract to that particular policyholder. However, the policyholder would still carry its mortality risk, morbidity risk, and it would still be able to enter into a contract that picks up a particular financial risk that already exists in the financial markets and transfer it to the insurance company. So this is an interesting discovery. It will tell us that obviously we have not read paragraph 34 perhaps as carefully as we would have done after having this discussion with the TRG IASB staff. But there you go. This is an example where now more clarity has been given, at least on one area. I have to conclude for this paper that the big issue around long boundary, short boundary is not settled in my mind, and I believe that there will be merit for that to be debated again in one of the future meetings. So now let's move on to the next paper. This is agenda paper 4 on the insurance acquisition cash flows that are paid excuse me, on an initially written contract. So the fact pattern here in the background talk about contracts that for one reason or another, it could be because you're selling separated insurance contracts that you have decided to agree with the staff, so you treat them as short-term contract, or they're actually a real short-term contract that nobody would argue with the conclusion. The point is that you have short-term contracts and you happen to have sold the first one to this particular contract holder, this particular policy holder. As a result of the fact that these contracts are renewable once they've expired, you may have decided to pay a particularly large commission to the intermediary that has secured the policy holder for the first time in your company. And this commission is paid for each initially written contract and is unconditionally paid to the agent. That means that the agent is not exposed to any clawback right from the insurer in the event that those renewals don't actually occur. So the expectation, in other words, is so high that a renewal will take place that the insurer has decided in his commercial wisdom to leave the money in the pocket of the agent and not to have any protection to claw back if the contract holder doesn't return and buy another 2 or 3 contracts. So then the question is, given that we have a commission, given that acquisition costs are defined as all those costs that are directly attributable to the portfolio of insurance contracts rather than the contract, how do we account for this large commission? Do we account for it only by the initially written contracts, or do we take a different view? The paper produces 3 alternatives. View A, which is the view supported by the IASB staff, is the view that says the acquisition of cash flows incurred should be allocated entirely to the group of contracts in existence at that time, and that means the written contracts initially in the period. Those will have to be treated as a separate group from all the other contracts that may be written in the same 12-month period, but for which no commissions have been paid, because they come as renewal of customers that were initially written in prior periods. The consequence of this is that the initially written group of contracts with the commission burden is likely to become onerous, whilst the others will be much more profitable because they are not suffering any commission in their measurement. View B is looking at the commission as relating to a group of contracts initially recognized and the group of contracts that are renewed but in future periods from the same customer. So this is effectively looking at the customers that were new customers, initially written contracts in the period, in the 12 months. We are looking and then we say actually this commission should be allocated to future groups. So it doesn't belong entirely to the accounting for the first group of contracts. We will defer an element, a large element of this commission for allocation to future groups as they are recognized. The view C is similar to view A, but in this instance we expand the group of contracts. We don't limit it to the initially written contracts. We also take in all the other contracts that are just renewal of initially written contracts from prior periods and treat them all as one group, effectively making the total cost of initially written contracts in the period absorbed by both the initially written contracts and the renewals occurring in the same period. The staff said that they rejected both view B and C in their own analysis. And so if we look at the discussion here, they noted that the non-refundable commission paid for each individually acquired contract are directly attributable only to the group of newly written contracts. So that is an interesting discovery, because although the standard talks about directly attributable to portfolio, what we learned last week is that directly attributable to contracts matters as well. Many TLG members, including me, agreed that the staff view paper and its logic, however, unfortunate from an economic representation perspective, was clear, and it was hard to disagree with them, other than to say that the economic substance did not appear to be portrayed as faithfully as one would have anticipated. I also observed that if we were talking about step-ready contracts, the conclusion of a short boundary would be regretted deeply at this point, because a long boundary instead would have actually absorbed the commission in an easy way without making anything onerous. Anyway, these contracts are short-term as a fact pattern characteristic, and so we need to treat them like that. So that means that we end up having the initially written group of contracts nearly always being onerous, and the one that follow that initially written contract will always be far more profitable than it would have been if an allocation had been done. I did challenge then the IASB staff to explain to us the meaning of the allocation of contracts, I beg your pardon, allocation of insurance costs, acquisition costs referred to in paragraph 27. In particular, what is the meaning of the word issued? And other members of the TLG actually joined me in seeking that clarification. And the good news is that we got some useful and frankly I would like to say positive clarification here, because the staff explained that the word issued is not to be interpreted as issued and reported from an initial recognition perspective. It's just a qualification to distinguish those contracts from those that would otherwise be in contracts held. So that means that when we have 27, If, based on what the staff told us earlier, we have insurance acquisition costs that are not directly attributable to individually acquired contracts, then the allocation basis of 27 applies, and even if we have not yet issued a new group of insurance contracts, but we have a basis to allocate a portion of those portfolio directly attributable acquisition costs to those future groups, we can do so and defer these effectively as a pre-coverage cash flow, if I use an old name that was used in the prior draft of IFRS 17, is an asset, an insurance contract scope asset, which is then reduced as those groups for which the allocation is appropriate emerge from the activity of the insurance company. So I felt that for that type of cost, which is still a very large majority of the acquisition cost incurred by insurance companies around the world, the allocation basis in 27 is now being clarified in a way that is quite helpful from a practical implementation perspective. I want to say on acquisition cost for one extra paper. This is paper number 6, but unlike the previous one, is in a very different context. The context here is transition. Paragraph C5 states that the fair value approach can be applied if it is impracticable for an entity to apply IFRS 17 fully retrospectively for a group of insurance contracts. And the question then is, if I do fair value that group of insurance contracts, do I need to create an acquisition cost element on the CSM? In other words, do I fair value the CSM gross and net of some form of acquisition cost? And if I do, the question is, where do I get the information for these acquisition costs, given that I am fair valuing prospectively the group of insurance contracts that cannot be practically restated? The discussion here was fairly brief. In fact, in the sequence of the discussion was towards the end of the day. The staff highlighted in the paper that they prepared on this submission that because the fair value approach is looking at the expectation of future and not past cash flows, the inclusion of past insurance acquisition cash flows is inappropriate. Therefore, if those insurance cash flows have occurred prior to the transition date, they will not be included in the measurement of the CSM, and therefore the CSM unwinding going forwards will only feed in the insurance service revenue line, and no expense gross up for amortization of acquisition expenses will be required for the group of insurance contracts that has been restated using the fair value approach. All TLG members agreed with the IASB staff view, so this is one that we can probably consider the clearest outcome of the debate last week. The next paper I want to talk about is Agenda Paper 5. This is the one that in my opinion, has a very, very material impact on the practicality of the implementation of IFRS 17, particularly for long-term contracts. The question here is, how are coverage units determined? Coverage units, as we know by now, is a new concept that IFRS 17 has introduced, and paragraph B 119A defines them as those units in a group of insurance contracts that represent the quantity of coverage provided by all the contracts in that particular group. And that will be determined by considering for each contractor the quantity of benefits provided and its expected coverage duration. Based on that, and given the submission is seeking more precise guidance on how to read this principle, the staff identified 3 factors that will, in different ways, help us determine the quantity of benefits and therefore the coverage units. The first factor is the variability of the benefits under the contract. If there is variability of the benefits across periods, then this means that the level of cover provided by the contracts and the coverage units will vary across periods. The second factor to consider is the likelihood of an insured event occurring, to the extent that the likelihood affects the expected duration of the contract. Given that B119A talks about the expected coverage duration, this will be a factor to be taken into account positively on the calculation of the time dimension that effectively will be used to consume the coverage units and effectively to take through the consumption of those coverage units P&L dollar amounts into P&L as revenue and profit. The third factor is the likelihood of an insured event occurring to the extent that likelihood affects the amount expected to be claimed in a particular period. And here I got these final bullets on the slide to remind us what the staff told us in the discussion, which is the pattern of profit recognition reflects the service provided over the whole of the coverage period and not just when a claim is incurred. And so the debate and the paper, as you have I'm sure read in your own time, has indicated that the expected claims are not a valid basis for determining the coverage units and for determining also how many of those coverage units are actually consumed in a particular reporting period to comply with B119A. The staff argue that the principle in IFRS 17 is that if there are different levels of cover across periods, those should be included in the determination of the quantity of benefits. The discussion also highlighted that this is not true only if a contract has got variable benefits, but even if you have fixed benefits at the individual contract level. When you look at the group, that fixed benefit, unless all contracts offer the same exact quantum of benefit, can be large in certain contracts and smaller in others, and that will still generate a degree of variability. This is a point where actually I requested a clarification of the interaction between paragraph B119 and paragraph 76 from the derecognition section of the standard. Subparagraph C for Charlie, of that paragraph 76 talks about the need for the insurer to consider how many coverage units have actually been derecognized as a result of contracts derecognition in the period. And the staff confirmed that this is actually a correct interpretation, and you need to use 76C in the context of B119 by effectively taking into account the derecognition, because that could have eliminated either larger or smaller contracts, and those coverage units needs to be taken out of the count of the remaining coverage units at the end of the period for the calculation of the CSM release and the CSM deferred for future periods. The discussion also highlighted that there was concern from a number of the members around new terminology the paper introduced, like maximum level of cover and the possible valid claims. Those things are not written in IFRS 17, and so a number of TRG members alerted the IASB staff and members to be careful in terms of explanation of the principle if those explanations actually become so dependent on terminology that is not cannot be found in IFRS 17. After all that discussion, it was deferred to defer the completion of the debate on coverage unit to the May TRG meeting, because a number of TRG members expressed their concern that any outcome reported at the end of the discussion last week would potentially be challenged back by the discussion of the second half of the paper, which is focused on insurance contracts with investment components, given that that could lead to more interesting assessment of how to apply the principle. So ultimately, the staff agreed to retable this paper together with the other half, which we have not seen yet, in the 2nd of May TRG meeting. But in the meantime, we were given some homework to do, and so we have to provide, by the end of this month, the IASB staff with our personal comments on the various examples that were attached to the paper. And that input will then be used to prepare a new version of the paper for discussion on the 2nd of May. I'm now going to talk to you about the last paper of the, if you like, large papers per submission that were tabled last week. This is a bit, again, a contraboundary, but from a completely different perspective. This is the boundary for a company that is buying reinsurance and is holding them on its balance sheet, or a cedent, if you want to use a precise industry term. Paragraph 33 and 34, in terms of background, are deemed to be still the only guidance applicable. However, there is a lack of clarity on the practical application of the criteria, particularly those in paragraph 34. And the staff explained in the paper that in order to apply 34 properly in the context of a reinsurance contract held, the cedent will need to consider the ability of the reinsurer to exercise its rights and to have obligations and consider them in a similar way as the principles of 34A and B that we talked about earlier would apply to an issued contract. So that in particular requires the cedent to consider whether the insurer has the right to terminate coverage. And if that right exists, it could be a very short boundary. And finally, the holder itself will have to analyze its own rights and obligations, which the paper explains need to be seen in reverse to the normal logic, and that could produce materially different outcomes if you think about it, because what is a right for one party is an obligation for the other, and so the right of the cedent is the obligation of the insurer. And in other words, the right, which is effectively the focus of the boundary set of requirements, in this instance is the right of the cedent to receive recoveries from the insurer, whilst the obligation is to pay the insurer to maintain that protection in existence for a period of time. So the key question really is, given all these reverse of the logic, would the principles in 34 still work okay? And if that is the case, how would they apply in practice? This was another discussion that produced some really interesting outcomes. And the first one is the fact that the debate highlighted that the underlying contracts that are expected to be issued in the future but are covered by the insurance contract could be included in the insurance contract boundary if the insurer does not reassess the risks to be transferred from the underlying contracts to be issued in the future. I did pick on that point, and I told the IASB that in my view the interpretation of the special concession in paragraph 62 extends beyond initial recognition and includes also measurement. Otherwise, I was questioning what is the benefit of the concession in the first place, besides deferring by a few weeks the recognition of a very complex calculation. Complex calculation that the IASB, as you can see from the last bullet on this page, acknowledge is real. They also observe that given that the concession is only for recognition, and then when you get to the session of the first contract, you have to estimate all the future new business streams that will be within the boundary of the insurance contracts that you have purchased. They observe that the insurer will have to do that even earlier. So imagine that you have acquired a proportionate coverage reinsurance effective from the 1st of January this year, but you have not written anything until now, 14th of February. So you got effectively 45 days before recognizing anything in your account. But when that first session is done, because I've written today a contract that happens to meet the conditions of the treaty and is therefore reinsured, I book not only the insurance asset that depends on the assumptions and the cash flows of this contract, the first one that I've stated, but I also need to take into account of an estimate of all future contracts that beyond today, 14th of February, I will be selling up to the end of the coverage of the insurance contract that I purchased. The insurer will have to do the same on the 1st of January. And this is a consistency of principle that the IASB explained was particularly close to their intention, however drafted that may have been in paragraph 62. We also discussed about the consistency of assumptions, and that will have to be developed out of existing contracts. So in this particular example, I will have to be consistent for the one contract written today, but then for everything else, given that they are future contracts, it's a completely open estimate, and therefore, given I've got no contract, there is no consistency test to be applied. It's a completely prospective, unsupported reinsurance estimation of what the new business is going to be, what kind of features it will have, and what the impact this future business will have in terms of present value of future cash flows, risk adjustment, and contractual service margin. Now, obviously, given that all of you know IFRS 17 very well already, you know that on day one, these three components produce zero. It's a nil result, which is true. And so on that point, in my balance sheet, I will still report only the effect of the first contract. However, that is true only on day one, because the CSM for all insurance contracts, given that they are scoped out of the variable fee approach, is invariably locked in, whilst the fulfillment cash flows and the risk adjustment is always unlocked in terms of discounting. So just for that very factor, the discount rate and the difference that will exist between the locked-in rate and the current rate, automatically I have two different elements within the nil balance that are reported on the date referred to in paragraph 62, and that could create a net asset or a net liability, even if no coverage or no changes in my projected future business has been made, because I've still written the only contract ceded to the contractor on the 14th of February. So that is clearly, once again, a significant operational burden for both cedent and reinsurer. Reinsurers, I was personally trying to strike a win for the cedents at least and save them from these complex calculations, but I'm afraid it seems that the staff in the IASB have a different perspective, and so that again, although is not authoritative guidance, but will have to be taken into account very carefully. Let me now move to the final paper presented last week, which is agenda paper 7, and this is just to let you know that there are a number of issues that were submitted to the TRG for discussion, but besides the 6 that I already covered, many others were dealt with more succinctly in paper 7. And this list, for example, of 6 papers with a relevant title relates to the fact that these issues will be dealt with by publishing educational material on these topics without any need for discussion on the TRG, because the staff and the board members deemed IFRS 17 guidance already sufficiently clear to provide us with a rejection decision effectively, if I want to analogize with the IFRS Interpretation Committee protocol, which is useful, very useful in fact, to tell us that the submission as summarized in agenda paper 7 should be dealt with again if we agree with the interpretation of the staff and the board members. Some other papers have been dealt with in a different way, and there are other non-TRG processes that the IASB will activate. For example, for submission 06 on business combinations on transition, there are some annual improvement activities at the moment on business combination, which will pick this up and potentially make an amendment to IFRS 3, if that is the conclusion, of course. Having said that, the next steps that remain now to cover in the webcast are that we have to observe potentially, if interested, the feedback to the board as a whole next week on Thursday, 22nd of February. That will be based on a summary of the outcomes paper that the IASB has published yesterday. The next TRG meeting will be again in London and is going to be held on the 2nd of May. There is always a potential for the TRG to be extended to a second day. We'll see if that is the case. And finally, already an agenda item confirmed for that meeting, which is a coverage unit paper, bringing in those examples of insurance contracts with an investment component. If you also want to read the Deloitte summary, we have published an IFRS in Focus paper. It's about 10 to 12 pages long. It's available in our IS Plus website for download at your convenience. And with that said, I'd like to take you to the last of my slides for today and invite Nikki to close the recording.